Scoring a multi-bagger stock that can double, triple, or even quadruple in value is the holy grail for many investors. And that's part of the appeal of deep value investing. The aim is to buy a stock trading at a steep discount and then potentially ride it to new highs as it recovers. Of course, this is all easier said than done. It takes a lot of knowledge, skill, and good fortune to earn those massive paydays. So in this episode, we'll hear how a master of the craft unearths those hidden gems and some of his words of wisdom for others looking to do the same. You're watching Inside Investing. Hello, everyone, and welcome to Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and joining us today is Sultan Ameerali, founder of Consolidated Rock. Sultan is a longtime DIY investor who has a ton of knowledge with deep value investing, and fun fact, he's a former colleague of mine from Business News Network Television. So Sultan, welcome on this program. Great to have you here. Appreciate you taking the time.
Thanks so much for having me, Rob. It's always good to see you.
You know, I've heard you say that working at a place like BNN was like the awesome crash course in all things like finance, investing, and stuff like that. So I'm kind of curious, how do you feel that experience there and your experience as like a business journalist in general kind of brought you to deep value investing and maybe even helped you, with pulling it off?
I would say one of the things about BNN, you and I both started our careers there working at something called the writer's desk, and that was where the Bloomberg terminal, all the information came in on a function called NI News, and it was just this fire hose of information that your job as the person who worked at that station was to look at that, look at what came in, assess it for value, and then send it out to the newsroom if it was valuable. And I can't think of a better training ground to understand financial filings, news releases, what matters and what doesn't than that job. And it really set me on my way. I think I already had an interest in investing, but that job allowed me to see what I didn't know, and it allowed me to pick up sort of knowledge without even knowing that I was picking it up, just by understanding why stocks were moving, calling people to find out, what am I not understanding about this news release that made the stock move up or down. It was a great learning environment and kind of set the bedrock for everything that came after it.
There is nothing more terrifying than getting this wall of emergency red alert, breaking news alerts at like 6 o'clock in the morning when you're a 23-year-old kid.
Yeah.
I'm getting flashbacks to it right now here, but it was a fantastic learning experience. I will agree with you there. So pretty recently, you kind of started blogging at your website, Consolidated Rock, kind of sharing some of these insight that you've got from deep value investing. I'm curious, I know you're a journalist, so maybe you have a knack for writing and an interest in writing in general, but what kind of made you want to start the blog and kind of sharing your deep value investing experience?
Yeah, I think people become better investors when they write their thesis down. I think the other thing that allows people to become better investors is putting your thesis out there for scrutiny and allowing others to tear it apart. Because to me, I would personally rather know I've gotten something wrong early on before I've invested a lot of time and money into it than later on down the line because I kept it to myself. I think the other thing that writing does is it forces you to apply a level of intellectual rigor. So, you're less likely to just buy something because you heard somebody talk about it on TV or you heard it mentioned or the stock price is going up. I think if you're going to write it down, then it forces you to understand it. The stock does not know that you own it, and invariably it will go down after you buy it. So you have to know enough to understand why the stock is moving and understand enough to know that, this is an opportunity to add or something has gone wrong and I need to exit my position.
Deep value investing obviously does take a lot of time and effort and research and stuff like that. So really excited to hear more about your process, about how you go about doing it. And just a quick note to our audience: make sure that you stick around to the end of this conversation because we're going to hear some of Sultan's biggest successes and failures. We often learn the most through failures, of course, at the end of our conversation, and some of the lessons that he learned that can help others as they kind of go through this deep value investing process. So stay tuned for that. But with that said, let's get into it. So I think maybe let's start. Before we get into the weeds, let's start with some of the basics. Okay, like how would you describe a deep value stock to somebody who's kind of new to this, and how do you kind of separate, the fact from fiction, as it were, a deep value opportunity versus a stock that's just down in the dumps?
Yeah. I think the thing people need to understand is that when most stocks are probably appropriately priced, and if its stock is down in the dumps, most of the time it's probably there for a good and legitimate reason and should probably be left there. On the other hand, there are a few instances where if you dig a little deeper, you can understand that maybe it's something temporary. And so what you're looking at is a situation where maybe the assets that make up the stock or make up the company are not being reflected in the price, and your job as an investor is to figure out why, and more importantly, to figure out how that value is going to be realized over time. You're looking for distress on the balance sheet that might be temporary in nature, not permanent in nature. So you need to understand the capital structure, and you're also looking for what I call turnarounds. Something's gone wrong with the company. The old management has resigned, new management has come in. A lot of times when new management comes in, they have a plan to turn around the company, and it's not reflected in the stock price, and all the old investors have exited out, so sentiment is bad. Those can be a lot of times the most lucrative deep value situation because it involves a catalyst in new management, but also one of the underlying pieces, which is assets that aren't recognized on the balance sheet or a distressed capital structure that can be turned around very quickly. In the old days, Rob, I would sit there and go through CDAR every day and look at what was interesting. And it was sort of this blunt force screen in order to see what was interesting and what wasn't. And I would document everything. And now I don't have to do that as much, if at all. Ideas will come to me and I can filter.
Yeah, I remember trawling through CDAR, the world's worst designed website of all time. Still living in the GeoCities era of the internet here, but there is a lot of great stuff there
Yeah.
if you know where you're
If you know
looking.
where you're looking, absolutely. It's a great place to start. And quite frankly, anybody who's investing in Canadian capital markets, you absolutely have to know how to use CDAR to find what you're looking for.
This all sound like things that a simple screen just simply can't tell you. Like you have to really get in there and understand what you're looking at. And that said, of course, a lot of effort can sometimes result in big payoffs. So
Yes.
I'm really curious. Like you've said that this approach, you said that it has given you life-changing amounts of money. I've heard you use that quote, and that really piqued my ears. So I'm curious, like what are some of the bigger returns that you've got using a deep value investing approach?
Yeah. So I'll give you a few examples on a high level. Australian mining stock that was trading around 8 cents Australian. This wasn't about drill results or anything like that. They had an existing uranium mine that they'd put on care and maintenance because the uranium price had turned negative after the Fukushima nuclear disaster and had been in a 10-year slump. For me, looking at that, I saw a company where the asset wasn't in production, but the balance sheet could take them through to a point probably 18 to 36 months out where they would be in production and generate a significant amount of cash flow based on where I thought the uranium price would be. In that case, that stock is still trading today. It's trading close to $1.50 Australian. I would have exited my entire position probably anywhere between 80 cents and a dollar. And that is a very good example of what I call a 10 bagger. For the capital I put in and the capital I got out, I got for every dollar I put in, I got $10 out the other side.
You kind of took the words out of my mouth because I was going to ask, first off, how willing are you to kind of hold these stocks for really long periods of time in order to get that payoff? But then the other part of it is, what kind of return do you need to see in order to justify tying up your money for so long,
Yeah.
and to some degree taking a higher amount of investment risk?
For the extra risk, the extra work that goes into it, I have to be significantly rewarded. And so to me, that 5X over 5 years is what I'm looking for. It rarely works out that way where it's a clean 5X over 5 years. It usually overshoots or undershoots, but it gives you for me, a good mental guideline of, okay, this doesn't meet the return threshold for what I'm going to do. So if it doesn't meet the return threshold, doesn't mean it's uninvestable, but there has to be some other safety factor involved.
Is there a length of time where you're just like, all right, I've had enough, like this is just not panning out the way that I thought? Or are you potentially looking to hold stocks 10, 15 years if you had to, if you still kind of believe in the thesis?
Yeah, a deep value tends to surface anywhere between 18 and 60 months, with the sweet spot being around 36 months. And so 3 year, if 3 years out, nothing, your stock has not moved one way or the other, you really have to ask yourself why. And a lot of times that could be because you bought what's called a value trap, where the value is there, but there's no way to unlock the value. So the difference between I would say deep value investing and so sort of mechanically buying cheaper than below net asset value or below book value. Sort of standard old school value investing is the catalyst. If you have a stock that is mechanically cheap and there's no way to close that discount, you could be waiting a long time. And it doesn't mean that it's uninvestable, but you can't assume that it's going to go back to book value if it's never been there before. For me, average holding period, probably about 36 months. I've held as long as 7 or 8 years, and that's because a thesis can change over time. And if you're holding it that long, it's generally probably changing in a good way, in that the business has evolved and morphed and become something more than what you thought it was. On the other hand, if I've sold as quickly as a quarter or a month, if I bought an initial position and then something's happened and it's turned against me, I it's a hard lesson that you only have to learn a few times. You don't hold on to something when the thesis breaks. You get out.
So, I mean, it sounds like conviction is really like the ultimate thing that this all boils down to when you're deep value investing. And it takes time to build conviction and knowledge to build conviction. So I'm curious, how much time are you putting into the research before you find that you reach that conviction point and you're ready to craft a thesis and potentially make an investment?
For me, a few hours. I think for somebody who's just starting out, um, who's reading probably 5 years of annual reports and filings to understand how the company got to where it is, who's talking to a few people who maybe understand the industry overall. Um, I would say a minimum of 5 hours, probably more than that, because special situations are not easy to understand. Distressed assets are not easy to understand. So I would be very concerned if somebody said that they analyzed a deep value, complicated investment and was able to come to a decision in 3 hours. And I get theses like these all the time, where it's somebody's written something and it's based on a few financial metrics, and it's clear they haven't talked to any customers, they haven't talked to any suppliers, they haven't talked to anybody involved in the company with the company or in the industry, and so they don't know anything more than the average person. And they've drawn a conclusion and put their money in. And to me, you can't do that. So I think, to answer your original question, a minimum of 5 hours, and probably closer to 20 or 30 hours if you're going to make this a large position that's going to hurt if it goes the wrong way.
Let's talk a little bit more about that mosaic, because this is at the heart of your research process for deep value investing. Mosaic approach is something that is used in like intelligence agencies and stuff like that. Tell me, how does this apply to your deep value investing?
As you say, this was developed by intelligence agencies as a way to take disparate pieces of information, put them together, and try to get a whole picture of what you're looking at. And so I just go into it and I just try to get as much information as I can. So I will start with filings and financial statements and things that everybody has access to it's just the easiest way to screen for things that I don't want to invest in, because if I'm not going to invest, it takes me 20 minutes at this point in my life to figure out, okay, there's something wrong here. The capital structure is all screwed up. This is going to go bankrupt. Doesn't mean it's uninvestable, but it means it's uninvestable today. And maybe I want to wait until it goes bankrupt and come back to it later. So I start there, and then I will add pieces on. So I might start talking to people in the industry. Hey, what am I missing about this stock? How did it get in this situation? Compare that against what's in the filings versus, what people are telling me. And maybe I get a piece of information I didn't know. Hey, this former CEO was, cutting a bunch of stuff that he actually needed in order to drive sales. Short-term results came at the expense of long-term profits. That sort of thing. The other piece that I really like is I use LinkedIn for a lot of my sort of on-the-ground research. And what I'm targeting are, for lack of a better term, mid-level managers. So people who aren't in the C-suite, who are used to talking to people. And what I just want to know is what it's like. I'm not looking for material information or anything like that. What I want to know is what's it like to work there? Are you looking for another job? How do you feel about your job right now, right? And you get a lot of interesting information. It's like, like people maybe tell you, I'm working nonstop. We've got a bunch of orders coming in or something like that. Or I really like this new guy. He's giving everybody a raise. He wants to keep people around, right? And you never know what's valuable until you kind of put it with the rest of your mosaic, right? And so I find that super helpful because it gives me an insight into the company that I can then use when I go and say talk to an industry expert who maybe doesn't work at the company. And then the last piece that often for me is actually talking to management. I want all my pieces ready so that when I talk to management, I can kind of make it count. So I'm either talking to management right at the end after I have a good idea of what I think, and I want them to either prove or disprove. Or I'm talking to them like way in the beginning, and then I'll come back to them at the end and say, okay, well, this is what you told me up front. And oftentimes, if I'm talking to them up front, it's a very perfunctory conversation. I don't know anything about the company. I'll let them tell me their story. I do my research, and I might come back at the end and say, like, oh, what about this? What about that? And I ask more specific questions.
And so tell me how the pieces of the mosaic come together. Like, what are some of the things that you need to see for each of those kind of categories that you talked about there that bring you to the point where you could say, okay, this is potentially investable now?
I want to see the why. Essentially, why is this cheap? Why is it going to go up? Why am I so lucky? And then there's the other one, which is the when. What is the timeline to get from where we are today to where I think it's going to go? What benchmarks do we have to hit along the way? What are the potential pitfalls, and which of these pitfalls are lethal versus okay, these are things that could happen, but and again, because nothing plays out exactly the way you think it will. So for me, that's what I'm looking for. I'm looking to understand the potential value that can be surfaced, and on what time frame is that value going to be surfaced, and are the people in charge the people who are going to do that?
So when you log on to something like Sidar and you're looking through financial filings and stuff like that, what catches your eye? What are the things that tell you, hey, there could be something here. It's worth my time to investigate it further?
So I'm looking for filings that it's called a material change report. As the name implies, there's been a material change in the business. Now that can be good or bad. So keep that in mind. So, okay, material change report. That's interesting. What's changed? What happened? What did, okay, that's a piece of information. I'm going to put that away. That could be interesting. There's another filing called a normal course issuer bid. In plain English, that just means the company decided to buy back shares. Well, anytime a company, now keep in mind, this is announcing a share buyback, not actually executing a share buyback. So, okay, that company's buying back shares. They must think they're undervalued. There's only one reason to buy in your own shares. That's worth further investigation. Have they announced buybacks in the past? Have they executed on those buybacks? That could tell you something. The other thing that I look for is certain times of press releases around stock options and employee stock options. So if I know the CEO is getting a series of stock options, for example, and they might expire in 3 years, and say, hypothetical example here, there's a mining company that I own. The CEO is not taking a salary. He's taking over a company that was kind of in trouble. So he's not taking a salary, but what he took are 1 million stock options at the current market price. What does that tell you? Well, that tells me that there's only one way this man can get paid. And that way to get paid is that he's going to sell this company to someone else at above the price that his options exercise at. And that tells me a lot about his incentives and where he's set up. So now it's my job to figure out, is the company worth significantly more than where his options exercise? So that's another thing. I think the other thing that I like to look at is what's called the management discussion and analysis. So if it's a company that I'm familiar with, but maybe I've not invested in, I'll go and take a read through that. There's a section called liquidity and capital resources. Gives you a good indication of whether the company will survive and has any kind of balance sheet problems. If it does have balance sheet problems or it's in a bit of distress, it'll give you an indication of how they think they're going to get through. The other thing that I look for in what's called an MD&A is a going concern warning. Going concern warnings basically mean that somebody has decided that there's a big risk that this company is going to go bankrupt and they've had to put this into a filing. Now, that doesn't necessarily, if you're really skilled at this, it doesn't necessarily disqualify something as an investment. And one of my larger investments right now, when I was buying it, it had a going concern warning. And so it's just, to me, it's a flag that further research is required.
How many people do you find you generally speak to before you kind of move on to that last step of the process where it's talking to management and stuff like that you mentioned?
I've had high conviction positions where I've talked to one person and everything has fallen into place. I've had high conviction positions where I had to talk to five people, in detail and multiple times in order before it kind of falls into place. In a more traditional company that maybe produces a product, what I'd like to do is ideally talk to a customer of said product, talk to somebody inside the company and maybe an industry, somebody who understands the broader industry. Because I'm a generalist, and there are obviously things that as a generalist I'm going to miss. The other thing, but I would caution with you don't take everything anybody says at face value, and the reason for that being is, are they doing it because they're actually good people and they don't want you to lose your money on their recommendation that something is, because they think they're recommending something to you? That's fair, and that's what good people should do. But you also have to understand that okay, well, that person is kind of biased, or maybe they have a lot of experience, so they're being kind of influenced by their current experience in the industry. And if if you can take a step back and put the broader pieces together, and that's your job as an investor, to put the pieces together of your mosaic. If you can take a step back and say, well, I understand what he's saying, but that actually feeds into my thesis because the sentiment is so bad. And so if I'm correct, and the entire industry is going to turn, then maybe sentiment goes the other way.
Let's loop back to that management piece, because this is kind of like the, if you want to call it, like the bow on the present here, right? Like this is the last piece for you. What are you trying to get out of a management team when you, and if you get a chance to speak to them?
A lot of times when you're talking about deep value or special situations, it's the value is going to be surfaced through some unusual way. Then that where I'm finding a lot of value recently is intellectual property. So if you're in a situation like I am right now, where something was trading at a fraction of the fair value, but the fair value is predicated on a patent infringement lawsuit, so you have to go to court. Well, that's a completely different way of surfacing value than most people are used to. And so when I'm talking to the CEO in this case, and people around me, I want to understand from experts, are these patents defensible? Yes or no? What's the upside downside based on winning versus losing in court? I want to talk to the company to understand how they finance this lawsuit. Lawyers are not cheap. How are they going to keep the company afloat while they wait for a judgment to come through? And what are their plans for the money, right? Because we're talking about capital allocation. That's a key skill when you're talking about deep value, because a lot of times the business turns around and the stock price doesn't reflect it for whatever reason. And it's usually because it's been down in the dumps for so long, it takes people a long time to figure it out. I want to know that my CEO is either going to buy back shares or do something that's going to add value to the business, and not, quite frankly, do something that is going to drive me nuts. And it's happened to me before, where they tell me they're not going to make an acquisition, and they go out and make an acquisition with stock that I consider very cheap. And they'll give you all kinds of reasons for it. And it's just like, these guys really like running this business, and they're good at running this business. What they're not good at doing is generating a return.
Are there certain red flags that you'll see either in the financial statements or in speaking with industry folks or the management team that tell you, full stop, I don't want to touch this thing?
I think it's personally, especially when you're starting out, it's very important to deconstruct a balance sheet. You're just going to see long-term liabilities, short-term liabilities. It's very important to pull that apart and understand, okay, well, there's a series of notes and they're due on these dates, and this is non-recourse debt and this is recourse debt. You really have to drill down and understand what makes up that debt, because if the debt is due in 30 days and there's no way to pay it back, that's a problem, right? So that's a red flag for me. Understanding how the company, what kind of cash generation is there to move this debt down. I think it would be instructive for people to look at the enterprise value of a stock, where you add the debt plus the market cap to understand what it would cost you to own the entire company. If you do that, the red flags become apparent when you say, okay, well, there's not enough assets here to pay off this debt. Even if they sold everything today, they'll generate enough cash to pay off this debt, or at least make the payments and refinance the debt. That's a problem. 90% of the, or 95% of the things that you're going to say no to, you're going to be able to say no in the first 20 minutes because something in the filings just threw you off.
How do you arrive at a price target for your investments? Is there a formula that you have that helps you piece together all the bits of the mosaic into a price target of some kind?
So what I'm trying to come up with is a range, a range of outcomes. A probability weighted analysis gives me one number that I can look at and say, okay, well, given the probability of any number of scenarios, probably going to end up here. Where am I buying it at to get there? And so it's less about the price target and more about understanding if that things execute the way I think they will, then I'm looking at a company that should be worth 5 times what I'm paying for today.
Gotcha. And we appreciate you walking us through your research process here. There's a lot to it, but for good reason, right? I mean, these are difficult situations to play in many cases, but the rewards can potentially be quite large. So that said, you did speak to us earlier about some of your big successes. Let's talk about the other end of the equation, some of the big failures and some of the lessons that you learned from some of those situations.
Yeah. Um, uh, oh man, there's so many things where it didn't go well. The number one mistake I made early on was talking to management too early. And this is one of the reasons I leave it to the end, because it's easy to kind of get wrapped up in the story early on when you haven't done your own work and you haven't developed your own conviction, and not understanding, well, what happens if they're wrong, or what happens if they don't actually get what they think they're going to get. And I'm not saying never trust management, but what I'm saying is just go into it with your eyes open and probably size the position appropriately. And one of the scenarios where I think I had my greatest failure, I ended up actually making money, but I made money for the wrong reasons. And so this was a mining company with a lot of debt on it, and the company that had taken over this mining operation thought that they could get it into production very quickly. A lot of infrastructure was in place, not much equity value, but a ton of debt. And so this idea that cash flow would come over time, and then the equity value would go up as the debt went down. And what I didn't realize is I was threading a needle. And so that idea of understanding when debt is due, and more importantly for me, as I learned the hard way, was what happens when the grade of the ore isn't what everybody thought it was, right? And so everything was working, and it's like, oh, well, the ore coming out of the ground isn't at the grade we thought, so we're actually getting significantly less for it. Well, that's a problem, right? And so that was actually a stock where my discipline and my process came into play, because I was able to sell. As soon as I saw that, I sold, and I was like, something's wrong here. This is not going to work. Because I was able to avoid a 5-figure haircut and end up with what turned into a 6-figure gain. That stock, I believe, has been delisted now, and that wasn't too long ago.
I've heard some value investors speak about the challenges of selling winners too soon. Has this been something that you've run into before?
Oh God, yes. Deep value investors are particularly prone to this, because if you think about a deep value investment, a lot of times it doesn't just invert, it goes the other way. And as the business kind of turns or transforms into something else, you can watch this, it just keeps going, right? And this is part of the reason I personally don't use price targets, because when early on I used price targets, it would get close to my price target or above it, and I would sell. And what I didn't do was reevaluate the business and update my price target. And so more than a few times I sold something and watched it go significantly higher. I know you and I talked about this earlier. There is a particular auto body repair chain that trades on the Toronto Stock Exchange. I believe it's trading somewhere above $200 a share or something like that. Now, I think what people don't know, this was a former income trust. It traded for pennies because it got into a lot of debt problems. This would have been 2008, 2009 when I first started at BNN. I think it would have bought in between 10 and 30 cents, and I sold around $1.10. Pretty good day at the office for young Sultan. I was like, oh, this is great. I had my price target. It was paying down some debt. But they're auto body repair shops. I don't know if that's a business I want to be in long term. Well, it just kept going and going and going and going. And, what mistakes did I make there? I sold everything at once. I didn't reevaluate my price target. I didn't make any effort to understand how the business had transformed. I didn't make an effort to really get to know management. That was a case where I was just buying off a balance sheet and understanding, okay, well, there's a lot of money coming in, and people have been washed out and the sentiment's bad. And what I didn't understand was management was really committed to buying back shares and returning capital to shareholders. And if I'd done it properly, I could have bought that and just gone to the beach, and it would have been life changing without a lot of extra work that would have come into reinvesting my proceeds from that $1.10.
You know what? It's cold comfort, I know, but you are at least in some good company. I remember a story that our colleague Francis Horodelsky told us one time, talking about how Apple was simultaneously her best trade and her worst trade.
Yeah.
For that reason, that she sold out much too early.
Yeah,
this was many years ago. Don't remember exactly when, but it happens. But the important thing is that we learn from it.
Yeah.
So hopefully that's the case. But in any case, I think we're gonna have to leave it there. Thank you for sharing those lessons with us to help people get on their way with deep value investing. Anything else you want to kind of throw out there that we haven't touched on in our conversation?
I wasn't too proud to ask people, what am I missing, to get people to teach me, right? And so I think it's important now, especially with so much information online, to absorb the right information and really put in that work to truly understand what you own, and don't take any shortcuts, because the work in this sector kind of compounds over time. And if you stick with it, it doesn't take, one or two trades can really kind of set you up for a long time, because if you're doing it properly, you don't have to cycle your money in and out all the time.
The key takeaways I'm hearing: know the company, know the financial statements, know the people.
Yeah.
Also know yourself.
Yeah.
And really know your thesis and what you're getting into before you kind of jump in. Sultan, thank you so much. This has been a fantastic conversation, super detailed, really giving us some insight into your process. We really appreciate it. And to our audience, I hope you enjoyed this conversation. Remember to register for our upcoming events as well, and check out our library of on-demand content available in the Learning Center, on Webbroker, as well as on TD's YouTube page. We will see you all next time. Thanks for tuning in.
Have more questions? Then check out the links to the right and in the description below.